In 1930, Herbert Hoover stood inside the White House and looked out at an American economy that was visibly disintegrating. Banks were failing in waves. Farmers were burning crops they couldn't sell. Stockbrokers were jumping out of windows. And the President of the United States said, well, almost the exact words an American president would say nearly 100 years later. He said it wasn't his fault. He said the Depression had started in Europe. He said Europe had overproduced wheat, rubber, coffee, sugar, silver. He said European politicians were weak. He said European cartels had distorted global trade. He gave only the most reluctant nod toward Wall Street, speculation, and that was it. The rest of it, every single piece of it, was somebody else's problem. Two of the most influential economic historians of the 20th century, Milton Friedman and Anna Schwartz, would later go through the data and reach a conclusion that was almost the exact opposite. They argued the Depression started in America. The crash of October 1929 was American. The 30% collapse in U.S. money supply between 1929 and 1933 was American, caused by American policy. The gold standard tied the world together, and when America convulsed, everybody else got dragged down with it. So who was right? And more importantly, why does this matter to you right now in 2026? It matters because the same speech is being given again. If you've turned on the news in the last month, you've heard it. The American economy is wobbling. The 30-year Treasury yield just broke 5%, the highest it's been in 19 years. Consumer confidence has fallen to 44.8, the lowest reading since the University of Michigan started this survey in 1952. The hyperscalers, Amazon, Microsoft, Google, Meta, are projected to spend more than $800 billion on AI infrastructure this year alone. Oil is climbing because of a war in the Middle East, and somehow the explanation we keep getting from Washington is that it's somebody else's fault. It's China's fault. It's Europe's fault. It's OPEC's fault. It's the immigrants' fault. It's anyone's fault but ours. I want to make a claim today that I think you'll find genuinely useful and a little disturbing. This speech is not new. Some version of it has been delivered by an American president, or a European prince, or an Asian finance minister every single time the global financial system has broken. For the last 400 years, not by one party, not by one ideology, by presidents of every stripe on both sides of the aisle for 2 consecutive centuries. Same beats, same denials, same accusations. And it doesn't matter whether the year is 1619 or 1720 or 1873 or 1929 or 2026. It doesn't matter whether the financial instrument is a debased silver coin, a bill of exchange written on parchment, a railroad bond, a credit default swap, or an algorithmic flow ricocheting through fiber optic cable at the speed of light. The mechanism is the same, the denial is the same, the outcome is the same. In the next 40 minutes, I want to walk you through 400 years of financial contagion, case by case, and show you the underlying engine that has driven every cross-border crisis from the 30 Years' War to 2008. Because once you see this engine, you cannot unsee it. And you will look at the headlines coming out of 2026, about Treasury yields, about consumer confidence, about AI capital expenditure, about the Iran-Israel war, and you will understand exactly which stage of the cycle we are in. This is not financial advice. This is how I am thinking about the longest, deepest, and least changing pattern in modern economic history, and why I think it is back right now. Let's start at the source. The book I keep coming back to is one that almost every serious finance professional has on their shelf, even if they haven't opened it in years. It's called Manias, Panics, and Crashes: A History of Financial Crisis. It was first published in 1978 by an MIT economist named Charles Kindleberger, and it has been updated 8 times since, most recently by Robert A. Leiber and Robert Macaulay. If you pull a copy off the shelf today and flip to Chapter 8, you will find something extraordinary. It is titled International Contagion, 1618 to 1933. 315 years of cross-border crises, and Kindleberger argues every single one of them follows the same playbook. He identifies 4 channels through which financial crises cross borders. The first is commodity arbitrage. If cotton goes up in Liverpool, cotton has to go up in New Orleans, because a single ship full of cotton sailing between them will close the gap. You don't need every bale of cotton to move. You only need one merchant doing arbitrage, and the 2 markets are locked together. Which means when British cotton demand collapses in 1864, it doesn't matter that your cotton field in Mississippi is perfectly healthy. Your price collapses anyway. You did nothing wrong. You are still ruined. The second channel is securities markets. If the same stock is listed in London and New York, the prices have to track each other because arbitrageurs will buy the cheap one and sell the dear one until they converge. Which means, and this is the part nobody likes to hear, a crash in one market guarantees a crash in the other. There is no diversification benefit when it matters. The third channel is capital flows. This is the deadliest one. When a country is booming, money pours in from everywhere. When the boom cracks, the same money sprints for the exits. The flow in amplifies the bubble. The flow out amplifies the bust. It is always, always gasoline on the fire in both directions. The fourth channel is what Kindleberger calls psychological contagion. One market panics. The next market panics. Nobody can quite say why. The fundamentals don't justify it, the numbers don't say so, but fear doesn't care about numbers. Fear travels faster than data. These four channels, arbitrage, securities, capital flows, panic, have been operating in slightly different costumes for 4 centuries. The costumes change, the mechanism does not. So let's go to the beginning. The year is 1619. Europe is at the start of what will become the most destructive war in its early modern history, the 30 Years' War. Religious tensions between Catholic and Protestant principalities are about to drag in every major power on the continent, and every prince, every bishop, every abbot, every elector, even the Holy Roman Emperor himself, needs cash. Lots of cash. Cash to hire mercenaries, cash to buy gunpowder, cash to feed an army. There is no income tax. There is no government bond market. There is no central bank. There is one thing every ruler does have, the right to mint coins. So they start cheating. They take silver and gold coins, melt them down, mix in cheaper metals, copper, lead, tin, and remint them at the same face value. A coin that used to be 90% silver is now 30% silver. The intrinsic metal is worth less. The face stamped on it stays the same. And as long as the public doesn't catch on, the prince has just tripled his money supply overnight. The Germans had a word for this. They called it the Kipper and Wipper site. Roughly, the tipper and seesaw period, named after the scales that money changers used to identify the few remaining good coins from the new bad ones. The diabolical part of this was the next move. A prince in one territory would mint debased coins, then take them across the border into the next prince's territory, and use them to buy up the neighboring prince's still good coins. Quietly, patiently, the neighboring economy got flooded with garbage. The original prince got back real silver. By the time the neighbor caught on, the damage was done. So the neighbor did the same thing to the next territory, which did the same thing to the next. By 1622, 3 years in, the contagion had spread out from Italy into southern Germany, then across the entire German lands into Austria, Hungary, Poland. Some accounts trace it as far as Russia, as far as the Near East. Prices spiked. Real wages collapsed. International merchants began refusing German silver entirely. Here is the detail I want you to remember. By the worst of it, the subsidiary coinage, the small denomination silver, had been debased so completely that children in the streets allegedly picked the coins up to play with as toys. The currency had stopped being currency. It had become litter. A regional coin worth 1/90th of a Reichstaler in 1618 was worth less than 1/390th by the end of 1621. That is a 4-fold collapse in real purchasing power in 3 years. Now hold this story in your head for a moment, because look at what just happened. A medium called money, in this case, a physical disk of silver alloy, was deliberately corrupted by sovereign issuers, and the corruption spread by arbitrage across borders, undetected at first, until everyone realized at the same moment that the medium itself had become unreliable. Replace silver coin with mortgage-backed security in 2008. Or Argentine bond in 1890, or Mississippi share in 1720. The substrate of the financial system gets corrupted. The corruption spreads. Nobody notices until it's too late. This is the original financial contagion. Everything else is a remix. Fast forward exactly 100 years. The year is 1720. It's the moment that historians sometimes call the first truly international financial crisis, and I want to walk you through why. In Paris, a Scottish-born financier named John Law had convinced the French crown to let him run a startling experiment. He had created something called the Mississippi Company, supposedly a colonial trading venture, but really a vehicle for restructuring the entire French national debt into equity. By 1719, the share price was tripling, quadrupling, going vertical. Around 30,000 foreigners poured into Paris just to buy shares. The streets around the Rue Quincampoix, where the trading happened, became impassable. English aristocrats wrote to their friends in Paris begging them to buy on their behalf. In May of 1719, the British ambassador in Paris wrote back to London in alarm. "Something must be done," he warned, "or all the capital of England will end up in France." So London did something. The South Sea Company, which had until then been a sleepy government debt conversion vehicle, was suddenly cranked into a speculative engine. Its share price went up sixfold in 6 months. Here's the part nobody likes to point out. The South Sea Company didn't actually do anything. Its core asset was a portfolio of British government bonds, yielding 5% that the government could redeem at par after 7 years. In modern terms, it was a closed-end government bond fund. And by June of 1720, the market was pricing this closed-end bond fund at almost 4 times its net asset value. A member of Parliament named Archibald Hutcheson sat down with a pencil, did the arithmetic, and published the obvious conclusion. The dividend math couldn't possibly support the price. Disaster was inevitable. Nobody listened. The stock kept going up. And now we get to the third character in this story, Amsterdam. Dutch interest rates were low. Dutch capital was abundant, and Dutch bankers, in the most professional possible way, were playing both sides. They bought Mississippi in Paris. They bought South Sea in London. And in some cases, the truly elegant ones, they sold at the top of both. There's a famous remark, attributed to a Dutch banker watching the spectacle from the Amsterdam exchange floor, who said the trading scene looked like the entire inmate population of an asylum had escaped at once. When both bubbles burst, in the autumn of 1720, the damage rippled through every connected market. French bankers were dispatched to London specifically to dump South Sea shares and ship the gold proceeds back across the Channel. Dutch banks called in margin and tightened credit. London's Sword Blade Bank, South Sea's effective house bank, collapsed. The Bank of England had to step in. One of the cleanest winners in the entire 1720 spectacle was the canton of Bern in Switzerland. The canton's government, using public funds, had quietly invested £200,000 in South Sea stock and pulled out near the top with £2 million in profit, a tenfold return on taxpayer money. In 1720. I'll let you decide whether the Bernese officials deserved a parade or a prison cell. But here's the structural point. In 1619, coins crossed borders. In 1720, exactly 100 years later, shares of stock crossed borders. The medium got faster, more abstract, more leveraged. The dynamic stayed the same. Hot money in, hot money out, both phases amplified. The substrate had upgraded. The Contagion engine was identical. Now I want to take you to a crisis that almost nobody outside academic economic history knows about, but it is one of the most important crises in the entire Kindleberger catalog because it shows you how Contagion works when the financial instrument isn't a coin and isn't a stock. It's a piece of paper. The year is 1763. The 7 Years' War has just ended, with the Treaty of Hubertusburg signed in February. Amsterdam is the financial capital of Europe, and one of the fastest-growing merchant banks in Amsterdam is run by a man named Leendert Peter de Neufville. De Neufville's business model is, in modern language, shadow banking. He doesn't take deposits. He doesn't make loans. What he does is endorse bills of exchange. A bill of exchange is just an IOU written by one merchant against another, drawn on a third party, often in a fourth city. Amsterdam merchants would issue a bill, sign it over to a Stockholm trading house, who would sign it over to a Hamburg house, who would sign it over to Bremen, who would sign it over to Leipzig. Every signature added a layer of guarantee. Every endorsement added a layer of credit. By the time the bill matured, there might be 5 or 6 names on the back, each of them theoretically on the hook if the underlying merchant defaulted. This is, beat for beat, the same financial engineering that produced the credit default swap market in the 2000s. Endorsement is just credit insurance with worse documentation. Kindleberger called this structure a house of cards. One nudge, and it falls. The nudge came in May of 1763. Grain prices in Prussia collapsed by 75% in 3 months because Frederick the Great released enormous wartime grain stockpiles into the open market, just as Russian armies withdrawing from Poland were dumping their own grain. The price of the underlying commodity, the stuff actually being financed, went down by 3/4, almost overnight. Bills of exchange backed by grain shipments became unpayable. The first endorsing merchant couldn't pay. The second endorser had to make good. The third endorser took the hit. The fourth, the fifth. De Neufville's bank, with hundreds of these bills outstanding, collapsed in August. Hamburg merchants frantically wrote to Amsterdam, "Save these people, or we go down with them." The letters arrived too late. When the dust settled, the de Neufville estate could theoretically have paid creditors 70 cents on the dollar. If the creditors had been willing to wait, they weren't. They settled for 60. And here is the detail I want you to hold on to. The Hamburg creditors of the Debased Bank waited 36 years for that final settlement. 36 years. Think about that. Someone lent money in 1763 at age 20. They got their 60% back in 1799 at age 56. That is the reality of an 18th century financial crisis. Not an abstract recession, not a quarter of negative GDP, a human being's entire working life. In 2008, we called this counterparty risk. In 1763, it was called bills of exchange. The instrument was paper instead of derivatives. The principle was identical. And here's where the cross-Atlantic ping-pong begins in earnest. By the 1820s, the financial system had a new feature. Britain, having industrialized first, now had truly enormous pools of capital looking for yield. And Latin America, newly independent from Spain, full of mining concessions and railroad concessions and government bonds, looked like a beautiful place to put that capital. So London investors poured into South American bonds in the early 1820s. The bubble inflated, and in December of 1825, it popped. The first thing that happened, and this is the part that's important, is that European demand for imports collapsed almost overnight. Banks in Paris, in Lyon, in Leipzig, all came under pressure, not because they had lent to South America directly, but because their merchant clients had lent to companies that exported to people whose orders had just been canceled. In the cotton mills of Alsace, the cash flow disappeared so completely that the factories, these are huge industrial enterprises in post-Napoleonic Europe, started printing their own IOUs and using them as wages. Total emissions of these private paper substitutes ran somewhere between 9 and 16 million francs. Workers took the IOUs to the bakery. The baker looked at the paper, looked at his empty till, looked back at the paper, and accepted it, because what else was he going to do? Nobody else had cash either. This is post-industrial revolution Europe, and it has just reverted to barter plus private scrip. 12 years later, it happens again, bigger. The years between 1836 and 1839 are a tangled cross-Atlantic mania. The British are speculating in cotton textile companies, and in railways. The Americans are speculating in cotton and in land, specifically in the kind of land you could grow cotton on. Both bubbles are inflating at the same time. And the linkage between them is provided by British banks who are financing the American exports. In the summer of 1838, something specific and consequential happens. The Paris private bank Hottinger agrees to help a man named Nicholas Biddle execute a cotton corner. Biddle is the former president of the Second Bank of the United States, the central bank that Andrew Jackson had famously dismantled, and he is now running a state-chartered successor. His plan is to corner the cotton market by buying up futures, forcing every short seller to keep buying just to maintain margin and ratcheting the price of physical cotton upward. The corner works for a while. Cotton mills in Manchester, in Rouen, in Alsace get strangled. The raw material price get artificially jacked up, and the downstream factories that have to use cotton get crushed between rising input costs and weak demand. This is, by the way, the very first time in modern financial history that a futures market cornering operation in one country systematically destroys industrial workers in two others. It takes a joint Anglo-French intervention in November of 1838 to break the corner. Cotton prices collapse. Biddle's institution wobbles. The cotton mills in Manchester and Alsace, clinging on by their fingernails, take the second hit. By 1830, transatlantic trade and capital flows have become so deeply entangled that the question who started it has stopped having a useful answer. The contagion runs both ways. It runs continuously. It runs in real time. And let me note this for later. The United States winds up, after the Panic of 1837, in a slow-motion depression that lasts until almost 1843. 7 states and a federal territory default on debt held by British banks. The wreckage takes a decade to clear. Sometimes a crisis isn't one event but a wave that keeps coming back to hit the same beach. The crisis of 1847 left behind one of the most useful data sets in all of 19th century economic history. A contemporary chronicler compiled, month by month and city by city, every bank and every commercial firm that went bankrupt. And if you read that table from top to bottom, you can watch the contagion travel. August 1847, London, 11 institutions fail. September, the wave hits Liverpool and Manchester. October, 21 more in London, 28 in Liverpool, the first failures in Glasgow. November, 25 in London, 16 more across the rest of Britain. The first bankruptcies reach Calcutta, 5,000 miles away. December, The wave makes landfall in Hamburg. By early 1848, Britain has just about steadied itself. And then in February of 1848, revolution breaks out in France. In March, Germany goes up, and the financial wave, which had been receding, comes roaring back. March of 1848, 14 failures in Amsterdam, 14 in Paris, all of them triggered, more or less directly, by the political earthquake of the European revolutions. And there is a specific failure in Cologne on March 29th of 1848 that I want to spend a moment on. The Schaffhausen banking house collapses. Schaffhausen had a balance sheet that was, for the time, extraordinary in its concentration. Almost a quarter of its assets, land plus a single loan to a single property developer, totaled about 1.6 million thaler. The bank's entire capital was about 1.5 million thaler. In other words, the loan to one real estate developer was bigger than the entire net worth of the bank. This was 1848, not 2008. The structural mistake, a bank betting its entire equity on one concentrated property exposure, is exactly the same. When the political crisis triggered deposit flight, Schaffhausen could not survive. But here's the twist. Its failure triggered a regulatory reform. The Prussian government allowed Schaffhausen to reorganize as a joint stock bank, which was unusual for the time, on the strict condition that it could not speculate in real estate. That carve-out helped set up the broader German banking system that would explode into growth over the next 2 decades. Sometimes a financial collapse produces the regulatory architecture of the next century. That's what happened here. But notice what the contagion actually looked like. It crossed languages, it crossed empires, it crossed industries. A South American bond bust in 1825 became a French textile collapse a year later. A British monetary squeeze in October 1847 became a Calcutta failure 5 weeks later. A French political revolution in February 1848 became a Cologne real estate collapse 6 weeks later. This is what global capital flows look like, even before the telegraph. Even before the steamship is fully reliable. Capital was already mobile. Crisis was already shared. By the middle of the 19th century, the global financial system had its first true mass-market mania. In 1849, gold was discovered in California. In 1851, gold was discovered in Australia. Suddenly, the world had a vastly expanded monetary base. Credit ballooned, and the lead speculation in every major economy was the same: railroads. Railroads were the AI of the 1850s. They were the technology that was going to remake civilization. They had massive upfront capital requirements. They had long-duration payoff structures. They were financed by debt and by equity issued at increasingly heroic valuations. Stop me if any of this sounds familiar. The trigger, when it came from a war. The Crimean War between Britain, France, Turkey, and Russia cut off Russian grain exports for the duration of the conflict. Global grain prices spiked. Farmers everywhere, including the American Midwest, had 3 glorious years. Then the war ended. Russian grain came roaring back. Prices collapsed. The dominoes started falling again in a sequence Kindleberger has us trace step by step. An Ohio trust company failed in August of 1857. Within 90 days, the wave had hit New York, Pennsylvania, Maryland, then Liverpool, then London, then Paris, then Hamburg, then Stockholm. By November, the Bank of England had been forced to suspend its own statutory restrictions on note issuance. By December, Hamburg was importing emergency silver from Austria just to keep its banks open. A German Chamber of Commerce, looking back at the wreckage, wrote a sentence that I think we should all sit with for a second. They wrote, quote, "The world is one whole, and industry and trade have made it so." That sentence was written in 1857. Read it again and tell yourself it isn't the most modern sentence you have ever read about globalization, because it is. But the real masterpiece of 19th century Contagion is the crisis of 1873, and the 1873 story starts in a place you wouldn't expect. It starts with a war indemnity. In 1871, Prussia defeated France in the Franco-Prussian War. As part of the peace settlement, France was forced to pay Prussia 5 billion gold francs, an absolutely staggering sum. Roughly a tenth of that came as physical gold. The rest came in various forms, but the net effect was that France was bled white for 2 years, while Germany was suddenly drowning in liquidity. What does Germany do with the money? Builds, speculates, floats new banks, new railroads, new industrial enterprises. The unification high, the we have arrived euphoria. And capital from everywhere chases the boom. Austrian capital, American capital, everyone wanting a piece of it. In May of 1873, the Vienna Stock Exchange crashes. In September, the Berlin Stock Exchange follows. By mid-September, the crisis has crossed the Atlantic. J. Cook, the most famous American financier of his generation, fails on September 18th because he cannot market his Northern Pacific Railroad bonds. The New York Stock Exchange shuts for the first time in its history. November sees a second wave hit Vienna. And France? France, having been ruined by the indemnity 2 years earlier, had been deflating its way through 1871 and 1872. France was so beaten down that it hadn't joined the bubble. France was, and this is a Kindleberger point that I want you to remember, immune, because it had already been sick. The only thing that protects you from contagion is having caught the previous round. And this brings me to what I think is the cruelest mechanism in all of financial contagion. The year is 1890. Barings Brothers, the second most prestigious investment bank in London behind only Rothschilds, has spent the previous 5 years channeling roughly £140 million into Argentina. That is an enormous concentration of capital into one emerging market. By the autumn of 1890, Argentina has had a bad harvest and a failed coup. Its sovereign debt is on the brink of default. Barings is suddenly looking at a hole in its balance sheet. Now here is what's interesting. Barings doesn't only own Argentine debt, it also owns large positions in high-quality American railroad stocks. When the call on Argentine exposure becomes urgent, the question Barings has to answer is, what can we sell right now for cash? The Argentine stuff can't be sold. There's no bid. So Barings starts dumping the American railroad stocks. Aggressively. Not because the American stocks are bad, they're the best assets on the book, but because they're the only liquid ones. The selling pressure crashes American railroad equities. And the crash in American railroad equities triggers a cascade of bank failures across the United States. Banks whose collateral was largely American railroad stock. Hold that sequence in your head. The Americans did nothing wrong. The American economy was, in fact, doing rather well. But because British investors owned both Argentine debt and American stocks in the same portfolio, an Argentine harvest failure ended up bankrupting American banks. This is exactly what happened in September of 2008. When Lehman fell, every global investor was suddenly looking for cash. They couldn't sell the toxic mortgage bonds. Those had no bid, so they sold their gold. They sold their best emerging market stocks. They sold their cleanest, most liquid holdings. Good assets were sacrificed to cover bad ones. This is the cruelest law of financial contagion. You do nothing wrong. You sit in someone else's portfolio. They make a bad bet somewhere else. You get hit anyway. There is no diversification benefit when it matters most. There is only the question of whose portfolio you're sitting in when the call comes. Barings was eventually rescued by a consortium organized by the governor of the Bank of England. Without that rescue, Lord Rothschild later remarked, the entire private banking system of London might have collapsed. But the wreckage in America, in South Africa, in Australia, took years to clear. One British investment bank's exposure in Argentina ended up paying for collateral damage on 3 continents. And here's a piece of history that almost never gets told. In the years leading up to 1907, Italy had been growing. Capital was flowing in from across Europe. Credit was easy. Speculation was widespread. There were shell companies buying back their own stock with borrowed money. There were steel trusts paying dividends out of new debt issuance to attract more investors. Every modern fraud pattern was already running in Italy before the First World War. The poster child for this era was a bank called Società Bancaria Italiana, SBI. SBI's capital had grown more than tenfold in less than a decade. It got there by aggressively rolling up smaller troubled banks, expanding into new regions, and lending heavily against equity collateral. The head office in Milan, by the bank's own later admission, didn't really know what the branch office in Genoa was doing. In the spring of 1907, the central banks of London and Paris, independently but more or less simultaneously, decided they had to tighten credit conditions to defend their own gold reserves. The contraction hit Italy and the United States almost simultaneously. The instant the credit spigot turned off, SBI started to wobble. Branches were calling for support. Margin calls on equity-backed loans were going unmet. The contagion path here is worth tracing. Italy is linked to Paris. New York is linked to London. Paris and London are linked to each other. When Paris dumps British securities to repatriate capital, London tightens further. When London tightens, the United States gets squeezed. When the United States gets squeezed, every emerging market that depends on American capital gets cut off. In 1907, let me be specific, Italy was in the global financial system almost indistinguishable from a colony. A European nation with a long history, with industry, with a unified state, and yet its credit conditions were entirely determined by capital decisions made in London and Paris. Construction projects stopped, demand collapsed, output dropped, wages fell, and here is the saving detail. Italy did not completely collapse in 1907, and the reason it didn't completely collapse is something almost nobody talks about. It was rescued by remittances. Italian immigrants in the United States, working as longshoremen in New York Harbor, as coal miners in Pennsylvania, as construction laborers in Chicago, were sending money home. Every month, small sums, $25, $40, saved out of brutal labor in conditions you wouldn't wish on anyone. The aggregate flow of these remittances from New York to Naples and Palermo was large enough to partially substitute for the financial capital that London and Paris had just yanked away. Think about what that means. The official transatlantic financial system, the one we write the textbooks about, broke down in 1907. The unofficial one, built $1 at a time by laborers, held the country together. The real cross-Atlantic linkage, in the crisis year of 1907, wasn't a wire transfer between Threadneedle Street and Piazza Affari. It was the sweat of immigrants mailed home. And then we come to the one everybody thinks they understand, the Great Depression. Black Thursday, October 24th, 1929. The Hoover years, the Roosevelt years, the bank holiday, the gold standard finally cracking. If you sit down and ask 100 Americans what caused the Great Depression, 90 of them will tell you it was a stock market crash. Maybe 20 will mention the Federal Reserve. Maybe 10 will say something about international capital flows. Almost none will mention what I am about to tell you. The Depression, the global one, the one that lasted a decade and killed democracy in half of Europe, did not start in October of 1929. It started in July of 1927. In the summer of 1927, the Bank of England was in trouble. Britain was clinging desperately to the pre-war gold standard, at a parity that was probably 20% overvalued. Gold was hemorrhaging out of London. The Bank of England's governor, Montague Norman, asked his closest counterpart abroad, Benjamin Strong, the head of the Federal Reserve Bank of New York, for help. Strong agreed to cut U.S. interest rates, not because the American economy needed lower rates. It didn't. The American economy was running hot. But to make European interest rates look relatively more attractive, slow the gold flow into America and give Britain breathing room. Strong famously told the French central banker Charles Rist that he was going to give the American stock market, direct quote, a little coup de whiskey to the stock exchange. That coup de whiskey worked exactly as intended for Britain, and it set Wall Street on fire. By March of 1928, the American stock market was rising vertically. By the summer of 1929, the gap between on-use asset prices and U.S. fundamentals had become absurd. Foreign capital was being sucked out of Germany, out of Latin America, out of Australia, into Wall Street. The peripheral economies were already starving for credit a full year before the crash. When Wall Street finally broke in October 1929, the chain reaction was instant. American investors stopped buying foreign bonds. Germany, in particular, had been rolling over its short-term debt continuously, and now it couldn't. Global commodity prices collapsed in synchrony: wheat, coffee, rubber, sugar, silk, cotton, all down together. Latin American currencies followed. By the end of 1930, two of the most important private banks in Paris had failed, taking the French government down with them. Then in May of 1931, Creditanstalt, the largest bank in Austria, collapsed. In July, the Danat Bank in Berlin followed. Germany froze its external debt repayments. In August, foreign investors started a run on the Bank of England. In September of 1931, Britain, which had pulled the entire world onto the gold standard 60 years earlier, left the gold standard. Gold flooded out of America. American banks ran out of reserves. By March of 1933, the United States was forced into a national bank holiday, suspending the entire banking system. So who started it? Who infected whom? And this is where one of the greatest debates in 20th century economic history comes in. I want to spend a few minutes on it because I think it matters more than it gets credit for. In 1963, Milton Friedman and Anna Schwartz published a book called A Monetary History of the United States. They argued in roughly 900 pages that the Depression was made in America. Specifically, they argued that the Federal Reserve had allowed the U.S. money supply to contract by about 1/3 between 1929 and 1933. That contraction, more than anything else, turned a manageable recession into the worst depression in modern history. The gold standard simply transmitted the American monetary contraction, outward to everybody else. In their reading, the United States was patient zero. 10 years later, in 1973, Charles Kindleberger published The World in Depression. He argued, equally forcefully, that Friedman and Schwartz had told only half the story. Yes, the Federal Reserve had made disastrous mistakes, but the deeper problem was structural. Britain had been the global lender of last resort throughout the 19th century. Britain in 1931 was simply too weak to play that role anymore. America was strong enough, but unwilling. There was nobody in the global system willing to act as the international stabilizer when crisis hit. That vacuum in Kindleberger's reading was what turned a normal cyclical downturn into a global catastrophe. America's mistake wasn't tight money. America's mistake was failing to step into the leadership role that Britain could no longer fill. And then a third economic historian, Peter Temin, came in with a quieter but more disruptive argument that both Friedman and Kindleberger were overstating their respective single causes. The collapse, Temin argued, was overdetermined. Too many things broke at once. The American monetary contraction mattered, yes. The absence of an international stabilizer mattered, yes. But so did agricultural overproduction. So did the gold standard itself. So did the war debts and reparations from World War I. There wasn't one infector. There was a system that had been built for collapse, and any one of half a dozen shocks could have triggered it. So who is right? Friedman, who blames the Fed? Kindleberger, who blames the absence of a global stabilizer? Temin, who refuses to single out any one cause? It doesn't matter who's right. The point is, they cannot agree. Three of the greatest economic historians of the last 100 years, working with the best data available, sitting on 60 years of hindsight, with no skin in the game and no political pressure, could not agree on whether the Depression was made in America, made in Britain, made in the global system, or made by all of them at once. If they couldn't agree about 1929, with 6 decades of cold analysis behind them, what are the chances that we, in real time, in 2026, watching headlines and tweets and Fed minutes, will correctly identify who started the next one? We won't. We never have. And that, right there, is the third iron law of contagion. 400 years of these crises, and they keep telling us the same 3 things. The first law is that hot money always amplifies the cycle, in both directions. When a country is booming, capital pours in from everywhere, and the boom inflates faster than it would have on local credit alone. When the boom cracks, the same capital sprints for the exits, and the bust gets steeper than it would have been on local fundamentals alone. Dutch capital running into Paris in 1719, American capital running into Wall Street in 1928, Asian capital running out of Bangkok and Jakarta in 1997. The pattern does not change. Capital chases the boom. Capital amplifies the bust. There has never been an exception. The second law is the most painful. Every generation of investors in every country, in every cycle, believes that they will be the ones to escape the contagion. They have a story for why this time is different. France in 1847 didn't think the British crisis applied to them, until it did. Every emerging market in 1928 had a thesis for why the American mania couldn't reach them, and then it did, and most of them never recovered. The Asian economies in 1997, the Russian government in 1998, the Argentinian banks in 2001, each had a clean intellectual reason why they were insulated. And there is exactly one form of immunity that history has ever validated. It is, as Kindleberger noted, having just been sick. France in 1873 was protected from the global railway mania for one reason only. It had been beaten into deflation by the war indemnity 2 years earlier. It was too weak to participate, so it survived. That is the only documented vaccine for financial contagion. Having been ruined 10 minutes ago. The third law is the one we already started with. Blame travels faster than analysis. Hoover blamed Europe in 1930. Andrew Jackson in 1837 had blamed Britain. The British, in turn, had blamed American speculation. Friedman blamed the Federal Reserve. Kindleberger blamed the absence of a global stabilizer. Temin blamed everyone. Nobody has ever, in real time, looked at a financial crisis and said, first thing, what did I do? It is always, every time, who did this to me? Two governments watching a collapse will both insist that the other one was the first to sneeze. Sometimes they are both right. Now zoom out. In 1997, the Thai baht broke in July. Within 6 months, the crisis had crossed every border in Southeast Asia, jumped to Russia, and made landfall in Brazil. Argentina was hit anyway, even though it had a currency board that was supposedly designed to make it immune. Capital, flight, exchange rate spillover, psychological contagion. the same 3 channels Kindleberger had identified in his book about the 17th century. In 2008, Lehman Brothers failed in September. Within 10 days, global equity markets had crashed in synchrony. Iceland, a country on the Arctic Circle, with a population smaller than the city of Cleveland, had its entire banking system implode because British and Dutch depositors had been wiring savings into Icelandic accounts to chase a half point of extra yield. That is, exactly the same structural error as 1763. A small node in the middle of a giant interconnected web of credit takes on more obligations than it can possibly back. The only difference is the medium. In 1763, it was bills of exchange written in ink. In 2008, it was deposits flowing through SWIFT. The substrate had upgraded. The Contagion engine was identical. And here is the new wrinkle. The asymmetry has gotten worse. In 1929, an American market crash dragged the world down, but a foreign crash didn't always reach America. In the 1990s, Japanese equities lost 3/4 of their value, and the American market kept going up as if Tokyo wasn't even on the same planet. But in 2001, when the American tech bubble burst, it took Tokyo and London and Frankfurt with it. The link is one way now. America breaks, the world breaks. The world breaks, America mostly shrugs, until the day it doesn't. Look at the map of 2026. The 30-year Treasury yield has broken 5%, the highest level since 2007. Japan's 10-year bond yield has finally crossed the Topix dividend yield for the first time in more than 30 years. Japanese capital has just rediscovered the right to say no. Consumer confidence in the United States has fallen to 44.8, the lowest reading since the Michigan survey began in 1952. The hyperscalers are about to spend more than $800 billion on AI infrastructure this single year, financed increasingly by corporate debt that gets repackaged through private credit vehicles you can't see on a balance sheet. Oil is climbing because of a war in the Persian Gulf, and the Federal Reserve, watching all of this, is being told, publicly, repeatedly, to cut rates again, to help patch over the cracks. This is not the same as 1927. But the family resemblance is unmistakable. A central bank, under enormous political pressure, being asked to administer one more coup de whiskey to a financial system that is already drunk. In 1927, Benjamin Strong gave it. What happens this time we are about to find out. Let me bring this all the way back to where we started. In 1930, Herbert Hoover stood in the White House and blamed Europe. He was, by the way, sincere. He believed it. He was wrong, but he was sincere. Andrew Jackson, almost 100 years earlier, had blamed Britain. The British had blamed Americans. The French had blamed the Dutch had blamed the Germans had blamed the Italians. And the children in 1622 picked up the worthless coins off the cobblestones and used them as toys. Coins became bills of exchange. Bills of exchange became railway shares. Railway shares became sovereign bonds. Sovereign bonds became derivatives. Derivatives became algorithmic flows running in microseconds through fiber optic cable beneath the Atlantic. The substrate keeps upgrading. The speed keeps multiplying. The leverage keeps stacking. But the nature of money has not changed. The nature of human beings has not changed. We chase, we panic, we blame. We did it in 1619, in 1720, in 1763, in 1825, in 1847, in 1873, in 1890, in 1907, in 1929, in 1997, in 2008. And we will do it again, possibly this year, possibly next year, possibly in a way that nobody on Earth has correctly predicted. So let me ask you the question I started with. When every wallet in the world is tied to the same rope, and the rope finally snaps, who exactly do you think gets to escape? This is not financial advice. This is how I am thinking about the longest, oldest, and least changing pattern in modern economic history. Watch the headlines, watch the yield curve, watch the central bankers, watch who, this time, is being blamed. And remember, somebody somewhere has heard this speech before.